Alright, so PRCH Group just released earnings here. I watched them yesterday, very late for me. And then after the trading day here in the morning, finally doing a video now on the earnings. This is not the first time that stock has dropped with levels like this, minus 33%. And it will not be the last time either for a $1.3 billion market cap right now as I'm making this video. Let's compare it to competition. Let's talk about pricing and let's talk about why the drop. Starting with why the drop. We can look at the presentation for this, although some of the reasons are not included in the presentation. You have to remember earlier earnings reports for this. But don't worry, this is where I come in and I help provide some context in this case. Alright, so this was the earning presentation that you're seeing on screen right now. Management framed the earnings as strong results. I both agree and disagree in this case. We saw strong profitability. We see positive adjusted EBITDA. We're seeing amazing gross margins. Although if we look at this staple here to the left, reciprocal written premium RVP, you're thinking, oh wow, they wrote 137 million. Very good, you know, it's nice growth, it's faster than legacy companies. However, this is not what was promised in investor presentations on investor days and when talking about potential future growth in the last quarterly earnings call in Q2. So let me just bring up some more context as promised around this area. We saw last quarter they talked about being in 22 states, writing insurance in 22 states, and that potentially they were going to expand more and be in more states. And then, you know, I think it was the Goldman Sachs analyst asked about the number of states that they were present in. We heard once again 22 states. So although growth was strong, don't get me wrong, it's nice, the written premium is increasing, the market was expecting higher written premiums. And before this whole earnings call, the price to earnings ratio was roughly 30 at its peak. And now we can see that this has dropped down to 20. So a lot lower, focusing more on profitability, less on growth. And it actually makes sense to do the comparison now to some of the competition in this case. Before we do that though, let's just zoom out. We're seeing year to date still up 114%. This puts PRCH Group almost on par with the competition that I have compared them to quite a few times here over the years, namely Lemonade stock. They are up 106% year to date, although no profitability here in terms of adjusted EBITDA, and this is some of the challenges. They just reported earnings as well here, almost same date here, and they just had a massive increase here, up 25% instead, earnings here on the 5th, from $56 a share to $79 a share, and massive cap is now massively larger than PRCH Group at 5.5 billion. So compare this to PRCH Group 1.3, we can see that Lemonade is indeed pulling ahead. Although if we just look at some of the points here, we can see that yes, they had this revenue increase by 42% year on year that the market loves to see in the short term. So this caused stock price to surge in this case. Although we can see that gross margin a lot lower here than PRCH Group. It's in the 40s here, and if we take a look at the gross margin here, we can see that it's 82%. This was also one of the questions from analysts, why are they not scaling, writing more policies when they have such a nice loss ratio, such nice gross profit. They're very leading in these metrics. And the focus was, from management side, they had not pulled the growth levers yet, done the incentives, and still the agency part was just seeds for growth in 2026 rather than, we're going to get into those slides a little bit later, but rather than growth now. So prudence, they paid off some debt as well. Actually, we're going to go over the investor presentation and I'm going to show you the slides so you can see them for yourself. But then I have another competition here, a more mature insurance company, AIG in this case, trading at a price to earnings of 14. So PRCH Group, the earnings multiple a lot lower now, although earnings still growing positively, but the top line was a little bit lacking. That's the summary of the earnings call basically. But the stock has been repriced now, less growth is priced in, and this means that if management decides to show the market and pull these levers that they're talking about for more top line growth, well, then stock price will increase accordingly. But it comes down to management decisions basically, what they decide to do. And we need to remember here that Matt Ehrlichman, he owns a little more than 20% of this company. And as mentioned on the earnings call, more of a long-term focus in this case to create long-term shareholder value and cash flow for shareholders. And when I interpret this, I interpret slower, safer growth. I think that this was what the market did as well. We saw them buy back 2026 notes on debt, and with the cash flow for investors, that potentially, I would say at least 5 years out in this case, not being present in all states yet, still growing agency, plenty of time and room to reinvest into the business. But eventually, at least 5 years out in this case, well, we're going to see something like what the other insurance companies are doing, with a yield for AIG in this case 2.36% right now. A lot of them have yields in the 1%, so somewhere between 1 and 2% in yield once the growth has matured more. And then we see performance, let me do the 5-year one here, more in line with average market returns here. This is better than average market returns, 130% in 5 years. Normal is doubling every 7 years, but with current money printing, we see a lot of companies doing better on paper, not accounting for inflation. However, outperformance from insurance indeed, especially if you get the premiums right. We saw premiums being priced wrong in the healthcare industry with health insurance, and we've seen those stocks drop like rocks in that case. So PRCH Group flipped on its head the relationship. Slower top line growth, but good profitability and premiums being priced appropriately. Of course, one of the levers that they could pull is to get less profitable and give more discounted versions to get more growth going, give more incentives to agencies to write the policies. But then margins are gonna drop as a result of that top line growth. So it's always a trade-off. So key business updates. Insurance model exceeding expectations. Yes, very profitable. Now 89 home factors providing system margin advantage. So 89 data points. This was also expected to grow a bit faster. They mentioned using AI now to get insights from visual data, so pictures, video, like the guy who has the iPad and walks around and take pictures when you're moving out from the property. They have that software, and with this visual data you can get insights from AI. And I've seen a lot of projects like this in my day-to-day work, as I'm in the data center business, and people are training AI. The training part, the one that PRCH Group is in right now, is the most costly part. Running a lot of simulations on the data, making sure that the AI is accurate, that it's learning, that it's providing value. This is the investment, this is the costly part. But then once the AI is actually trained, well, then it costs a lot less just to run it on new data. Then you get the advantage. So it's a cost today, but it's an advantage tomorrow. And then in that case, I think it's very prudent to focus on profitability, make sure that you have the money to do these types of projects. Even the company I'm working on now has done this AI training, seen it up close. I've seen it up close in many customers. I know what it entails. I'm not sure that the market really knows, how the AI part works, but they sure love when it's mentioned in earnings calls for the most part. But yes, training on visual data, this will take some time. It's gonna run cost. They're gonna need some GPUs on premise, or to use the cloud, an AI cloud in this case, and pay for that compute as they go as a service. No comment on which way they went in that case, but this is a cost now for an advantage tomorrow. So prioritizing PRCH shareholder interest, profit, and reciprocal surplus generation. Generating surplus, generating more capital. This capital gives them opportunities. They can deploy it. They can deploy it into AI training. They can use it, leverage it to generate even more profits, in this case, from writing more premiums, having it as security. There's so many opportunities for capital. The CEO even got a question about M&A, and yes, they could use surplus for M&A activity as well, where it makes sense if they find some good opportunity. Although in my opinion, I think the company is far more likely to be bought out rather than buy something themselves, especially at current market cap. Although they are still a bit too small to really be on the radar for that. They need to be at least 5 billion to even get on the table, for someone like, say, Warren Buffett. He's not even going to look at a company unless it's greater than 5 billion. And for a lot of other larger companies, private equity, they're still too small in that case. Healthy top of funnel sets up attractive growth opportunity ahead. So strong agency appointments and quote volumes. This is not closing. This is one of the actions that leads to closing, with appointments and sending out a lot of quotes. But revenue would be larger and the top funnel would be more like lemonade in that case, if they just closed more of those. But just writing quotes and doing the appointments, it's a good sign. I know it's hard to develop channel. It takes time. They're starting to do it now, reactivating agencies. They're not just going to start writing a ton of policies for you off the bat. You're going to have to certify them. You're going to have to train them. You're going to have to touch the agencies. You're going to have to be there every day with agency reps and get them up and running off the ground, build that collaboration. We're here for the long term, and this takes time. I've done this with vendors in the IT industry myself, some of the IT partners out there in the Nordics. Channel work is hard work. It's not going to happen overnight, and I think that the market was not really prepared for that. They think, all right, we're activating a bunch of partners, boom, more revenue. But that's not the case. And to actually have sustained growth, it's not easy. You have to develop that relationship. You have to maintain it. And eventually, some of these partners, they're just gonna run on their own and bring you more and more business. But the risk with partners like that is you just touch them once, you sign them up, and then you do nothing else. They're not gonna bring you more business. You have to be there, touch them, nurture that relationship, develop it. Otherwise, that growth is gonna stagnate. And we see Lemonade flagging just about this stagnating growth if we take a look at some of the negative points here. So improvements, still reported EBITDA loss, yes. Competition here, they trade off profitability for growth. I did not agree with that decision in the higher interest rate environment that we're in right now. But the company is cautious about retention and growth in Q4, indicating potential challenges in maintaining the current growth trajectory. So competition flagged for this being a challenge, and for those of us who listened in on the earnings call, we saw that Matt Ehrlichman talked about that they would rather ramp up slowly and have it be sustainable rather than ramp hard now and then have troubles keeping that growth. So big slap short term. We can see, Lemonade stock jumping 25% versus Porch Group. If we take a look here on the 5 days, just dropping 31%. Big drop after earnings here in this case. So two very different approaches. I still believe in management in this case, being more prudent, paying off debt, keeping that profitability, making sure they have money for this AI initiative. It's going to cost a bit to train that AI for sure, but then when these things are up and running, much more easier to scale big time in my opinion, and developing these agency relationships. Surplus expanding, some of it from stock price increasing, some of it from written premium. We can see the results. So this is in millions here, 73 million in revenue from insurance, software and data, 24, consumer services, 19. So we're still seeing slow growth from software and data. We've seen this quarter over quarter now. This is priced in already with the slow housing market, and when eventually the housing market recovers, well, this will be a bonus, but I'm not counting on it in the near term. We need to see interest rate drop by a lot. We need to see a better job market. Times are tough right now for a lot of people. Let's keep scrolling a bit. We can see margin, nice and high. Revenue, could be better. Software segment, growing very slow. Gross profit, increasing. Revenue, increasing a little bit, but low single digit. So this is very slow growth, especially factoring in inflation as well and things like this. But not easy. So investing in software product innovation, including this AI in this case, yes, it's gonna take some money, but once it's up and running and getting more insights from that visual data, well, then it's gonna be good for us as shareholders, and then consumer services as well. Continued strong cash generation, this focus on profitability, it was reiterated many times. And we can see a repurchase here of 12.8 million in 2026 debt. So this means remaining 7.8 million. And with the final point here, board authorized management to repurchase remaining 2026 notes with cash from the balance sheet. So basically most likely cash from operations in this case, that can be used to repurchase this. Could also refinance, but given the way focus has been, they are paying down debt, and I think that they will continue to do this. And it's worth remembering that most businesses fail. A lot try to scale very, very quickly, and then they go under in many cases. And it's rare for a business to actually thrive and have this going principle and focus on going principle, maximizing shareholder value and continuing to operate forever. That's the fiduciary duty of management in this case, and I think that they are taking it very seriously. They still have my vote of confidence in that. Paying down debt, minimizing risks. Of course, one of the big risks still is black swan events. For example, remember AIG making credit default swaps on the housing debt back in 2008. They were bailed out in that case. Too big to fail. But a company like PRCH on 1.3 billion in market cap, if they do something reckless, then the government is not going to come and bail them out. They're gonna be left to deal with it on their own. So no issues with them being a bit hesitant in scaling, a bit careful, a bit prudent, although, the market is going to punish them. So guidance, once again, midpoint reiterated versus prior guidance. Some small increases. In the next quarter, we're going to see 2026 guidance. I think that will have a large impact on share price for sure. Will they focus more on growing? Will they continue to do what they do? Well, if they continue to do with profitability and grow like they do, then they are fairly priced. I think we're gonna see a nothing quarter then, with stock price still continuing to be around $10 a share. But if they grow the business more on the top line, well, then they are priced for a large increase in that case. Insurance services KPIs, the written premium in this case, driven by quote volume and conversion rate. Yeah. Agencies drive growing quote volumes, so they are scaling, only not fast enough. They need to continue to touch these agencies, build that relationship, have them write more premiums, and at one point, 22 states today, add some more states. As a shareholder, I hope they stay out of California and Hawaii. In my opinion, I think it's very, very high risk. We've seen some wildfires over there, and we know that it's a big risk to enter. So happy if they stay out of those, but they could add some more states. But of course, this is up to management. As investors, we can only make wishes for what we want to see from the company. Some software and data updates. The AI was the big thing in terms of software with home factors. 89 features, growing a little bit slow, as was pointed out, but once the AI is trained, well, it's going to be able to draw conclusions that no human is going to be able to do. It's going to see connections between visual cues and outcomes in terms of claims that we as humans would not even be able to imagine, basically. I've seen some of the things that AI can do in terms of detecting certain things. You've seen medical with the X-rays, and I've seen it be able to detect cyber attacks, see something is going on with the data. So just looking at visual cues, not going to be a problem. It's going to be a bit costly to train, but then once it's up and running, then it will increase the amount of data points in the home factor offering for sure. Not growing quickly on the software. You saw the 7% year-on-year, quarter-on-quarter revenue growth. And they're doing some trials with other insurance carriers in states where they are not present. They're doing the POC. It's a longer sales cycle to try to sell this type of SaaS offering, to try to sell this type of license. But then once it's up and running, we need to look at retention. If they continue to retain customers, then that's going to be a lot easier than signing them up one by one. And it's going to be very nice margin, very nice revenue for the business and for us as investors. So wrap up from Matt Ehrlichman, once again reiterating what a fantastic and strong quarter it was, while share price is dropping. But as I said in the beginning of the video, this is not the first time this has happened. It's not going to be the last time either. With small cap stocks like this, we're going to see larger swings. It's larger risk, potential larger reward. And it's important to zoom out and remember where we came from in this case. Taking a look at year-to-date performance of 114%. I remember before this stock was profitable, just how low it was trading. Was able to buy it at less than $1, $0.56. Average purchase price of $1.01, roughly 50,000 shares. So massive loss on yesterday's trading date. Of course, it's minus a couple of 100,000 in my portfolio in this case. But it's nothing I haven't been through before. If you just look out a little bit and you see how volatile stock price has been, up to $6, down to $5, and it's a very, very volatile stock to be in, and that's the risk that I signed up for when I purchased a small cap company like PRCH Group. It's going to be a lot more volatile than if you compare to the dividend portfolio that I'm building to smooth out my income, where I have another insurance company, United Health in this case. Started buying a lot below 300. There it's going to be way less volatile, even after this 50% drop that created a massive buying opportunity in that case. I also believe that this drop creates a nice buying opportunity in PRCH Group. I think that it's on the cheaper side of valuation right now compared to potential. Will I add to my position? No, I will not, because I'm very happy with having 50,000 shares in this company. I think that it's a substantial enough amount. It's a life-changing amount, has been for sure, and I do not need to add any more. This company performing well, and if it succeeds and continues on the trajectory that it has right now in terms of profitability, the growth is good, could be better, but if they continue on this trajectory of actually being a successful company, then for sure it will set me up for life. A very early retirement, potentially in Thailand, where I'm recording this video from right now. Bit of a longer video today, really digging into the details. I think it's important because I think that a lot of people get very scared when they see big price movements, and it's important to know yourself then how you react to big price movements. Is it something that causes you to panic sell? Is it something that you're fine with? And talked a little bit about the potential for large price drops in past videos about PRCH Group as well, talking about how this is something that will happen time and time again as you hold a stock for the long term. So as I said in the beginning of the video, not the first time that we're seeing a large drop, in this case 33%, and it will not be the last time either. Even for very, very large insurance companies, we see what happens if they, in the case of United Health, write the premiums, write the policy a bit too cheap. Well, we saw a 50% drop in that case as well. So you're never going to get away from this bumpiness with stocks. If you want to sleep very, very well at night, then bonds is gonna offer a lot less volatility, but also lower expected returns. It will not be the more than 100% gain year to date. Alright, that's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now, bye bye.